Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club. It is a beautiful December 1st. It's 2023 went by super quickly. I can't believe it's the end of the year. But I am super excited. Christmas is coming up, and we got Arleen Garza with us here on the podcast today. Arleen is from San Antonio, Texas, and the co-founder of Reap Equity. They do multifamily syndications, which we'd love to hear about. So, Arleen, I am super excited about this. Thank you very much for hopping on the show.
Thank you, Gabe. I appreciate you having me on the Real Estate Investing Club. I applaud your efforts. I think anytime somebody is sharing information with owners and investors, it makes us all better. So thank you for that and taking the time to have your podcast.
Yeah, absolutely. It is truly my pleasure. I love talking to people like you. So I'm going to start us off. I told you before we got on here, we like to start with stories. So why don't you take us back to the beginning of your story? How'd you get started in real estate?
Sounds great. Well, I was in banking for 20 years. Grew up in the western part of Texas and moved to Dallas to work for a large bank. And interesting enough, it was before one of the financial crises we've had in our country. And so experienced the bank failing and coming back out of that. So it was an interesting time.
Yeah.
Yeah.
That was before 2008.
It was in the 90s. Yeah.
90s. Okay.
Late 80s, actually. Late 80s was the time. So
that was when the interest rates were like 12% or something like that, wasn't it?
Yeah. Yeah. I managed banking centers, and I found an old picture the other day, and it had loans at a 12% APR at the time. So, to see rates today, yeah, they're higher, but historically they're not as high as they've been. So kind of interesting.
Right.
So anyway, I spent 20 years being a lender, running banking centers. I managed an international private banking portfolio, launched Bank of America's first ever Hispanic marketing program and took it nationwide. And so took all of that experience. And then we moved from Dallas to San Antonio when my spouse sold his property management software company. So he had about 20,000 users. And so when he sold, get this time frame, 2007 is when he sold. And of course, a year before the 2008 financial crisis. So it was very good timing. And, we kind of looked at each other and said, what do we do? And I wanted to move to San Antonio from Dallas because I had family here and our kids were still young enough. I wanted them to grow up in the city with a lot of cultural diversity. And so we moved here. Of course, that being the time frame, credit markets were frozen pretty much. And so we knew we wanted to explore multifamily, and we started really educating ourselves, joining real estate groups. There weren't a lot of podcasts or any of that existed back in that time frame. So it was reading and going, to hear other people speak about their experience. And so in 2012, we bought our first property in San Antonio, 24 units. And some people call us crazy, but we wanted to run it ourselves. We wanted to know how properties make money, what problems you can run into, et cetera. So I did leasing, accounting, that piece of it. And my spouse did the rehab and the maintenance side of the business. And so taught us a lot of good lessons. And then fast forward to today, we've closed on 32 properties, multifamily properties, about $750 million in assets over that period of time. And so we've seen a lot and learned a lot. So
absolutely.
And I think one of the things that I think we learned early and still hold to is that if you can manage your own, not everybody can. And there are some good property management companies out there, but if you can manage your own, I think, at least in today's world, we see a big difference.
Yeah. And I think it's such a good, like you said, it's such a good lesson to learn. Even if you want to get into the 1,000+ units in a portfolio, obviously you're going to need a property manager. But for those first few properties, if you can get the experience managing them yourself, you'll have a much better understanding of how to hire property managers, what to look for, what good performance looks like, all that kind of stuff. So I'm sure, managing that 24 unit what provided invaluable experience that you kind of brought on to your expansion later on.
It did. It started really early. The owner, California owner, the day we showed up for due diligence, pulled up in a green truck with a big suitcase, opened the suitcase, and there were a bunch of papers floating around in the suitcase. And he said, "That's all the data I have on the property." So we had to create the financials. We had to really organize the leases to even understand what we had. So you name it, we learned it, but we're grateful for that now that we did.
Yeah. And especially when you go into those situations where the seller has just crap, due diligence documents, generally you get a premium for that. You get to add that onto as the value of the property. You get kind of a discount in the purchase price if they're not able to prove their performance. So, yeah,
correct. Well, I would say 19,000 a door was a pretty good price.
Yeah, geez. Yeah, it is.
Yeah.
And you bought that in 2012. Oh man, yeah, you guys got great return on that one.
We did 370%.
Wow, that is great. And did you guys was that a syndication or did you guys buy that yourself?
We primarily ourselves. We brought in one partner because the bank wanted somebody with experience. Mm-hmm. And so we brought a guy and his wife in for a $20,000 investment. And that satisfied the bank. And he was a good resource for us too. When we had questions, he could help us through a lot of that. So I recommend it. If you can partner your first go round with somebody that's experienced, it makes a lot of sense.
Yeah. And even when you're switching between asset classes like self-storage to multifamily to mobile home parks, if you can get somebody who's already done it, even if you have tons of experience as a multifamily operator and you're switching over to self-storage, it's great to partner with somebody who has experience in that asset class because, there's a lot of nuances that you can learn from somebody who's already been there, done that. So I really quickly want to ask, you kind of not glossed over, but in the beginning of your story, you mentioned that you had 20 years of experience as a lender. So on the lending side, I'm sure that helped you a lot. How did that kind of play into your first few deals, larger deals that you closed on?
I think understanding what the lender was going to be looking for was key. And I think from the underwriting side of things, understanding how a lender will underwrite a deal makes a difference, right? What you believe you can achieve is one thing, but what the lender will sign off on is another. And so I think that was a big help. Plus, if our first loan was with Wells Fargo, so there was a little camaraderie there from the beginning because we were both, I had the banking background and we could talk shop a little bit about what I had done before. So that was helpful also. Yeah,
absolutely. So how from your experience, how does banking underwriting differ from, the GP, the operator, their underwriting? Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Yeah, definitely. Well, I think the lender will typically be more conservative. So one of the things we always do is we always have our deal pre-underwritten by our lender so that we know before we even make an offer, what the loan to value, loan to cost may end up looking like. And so we can build that into our underwriting. Of course, we have our underwriting, which is based on sharing that with our management company. We're vertically integrated, so we have in-house management. So we have a lot of data that we gather just from our properties, reporting rents in their areas every week. And so we have a real good feel when we do our underwriting, what rents are looking like. We're always conservative. And interesting enough, the lender, once they get comfortable with you, will buy off on a lot of it, but they're going to have their even more conservative slant. On the expense side, it helps that we're vertically integrated because they'll take our expense, our expense load from our end, because we can show them financials from the other properties in our portfolio to prove up the expense numbers. So I think that's important, but your lender is your best friend. I mean, if you think about in today's world, they're 65% of your capital stack coming to buy a deal. So they're your friend. And the better you understand how they're looking at the deal, the more successful you are going to be in getting them to sign off on that in the end.
Yeah, absolutely. So after that first 24 unit deal that you guys took down, how did you grow, or how did you grow the portfolio? Did you do it all in the same area? What was your plan when you thought about expansion?
Okay, great. Good question. So we bought a little bigger property around the corner from our first property with the thought that would give us enough units to at least have a part-time manager so that we could spend more time looking for properties. So that was helpful. So now we had 52 units that, could be run somewhat without us being there 100% of the time. And then we bought 88 units. So went a little bigger. And then 143. So just kept kind of scaling up. But initially, we bought 8 in San Antonio before we looked at another market. Part of it is we wanted that solid foundation and the team there to be able to grow with. So then we expanded into Houston next. A lot of it was because the demographics are very favorable. 51% of the households rent in San Antonio, about 55 to 56% of the households in Houston rent. And it's, 5 times the size of San Antonio. So we knew there were opportunities to grow into that area. But we knew we needed to buy them pretty quickly so that we could build the team to run them and to have leadership, a regional manager, capital projects, all of that in that market. And so we did that. And then our latest market is Austin. That's very close to us. We can get to any of our markets, very quickly. So that's helpful. And I think that's been a big thing. We've got our eye on DFW. We'll see what 2024 brings in terms of opportunities, because historically Dallas has been higher priced on a per unit basis, but the rents are higher. So we're watching all the data that's being shared on all the markets today, rents, you name it, and really keeping all of that, in mind.
Yeah. So, hindsight's 2020. And so, you did, however you grew your portfolio it had to have been done that way. But looking back, is there anything that you not necessarily regret, but you feel, for somebody, if somebody was growing a portfolio and really wanted to expand quickly, is there something that you did that you feel could have been done better in that expansion phase?
Yeah, I think we grew too slow, but we grew at the pace we were comfortable with. And sometimes you got to get uncomfortable to really move forward. And I think that's one of the things I would tell people is if you don't have the capability from a balance sheet standpoint, being able to qualify for the loan or the knowledge, partner. We had that small partner, but we didn't bring in investors until about our 4th deal. And so I think that was that was a mistake, honestly. We did fine, but I think if I had it to do over, we would have partnered faster and sooner.
Yep. And that's one of the great things about, podcasts, for one, being able to meet people. If you go on to podcasts, meet the hosts and all that stuff. And also events, like going to real estate events, conferences, stuff like that, where you get to go out there and meet people. And maybe one of those is going to turn into your next GP or your next partner, JV deal, whatever it is. So it's another reason, I always say real estate is a relationship business first. And that's exactly what the case is here. If you want to partner, you got to go out there and start meeting people.
I agree. What's it saying? Your network is your net worth. So that's important. I agree completely. As many people as you can meet, you're going to learn. But what I will say is, when you meet somebody that's a little more experienced, one of the things you sometimes hear is, I'd like to pick your brain. And I always say, bring something of value yourself. Bring something to the table, whether it's something you recently learned, when you have those conversations, because you'll tend to get more conversations if you're bringing some value to that conversation also.
Yeah, it's got to be a mutual benefit in the conversation.
Agreed.
All right. So we are running down the timer, but before we move on, I have to ask about your crystal ball. What does it say? You've been in banking, you guys have a great portfolio. So I'm sure you have a lot of opinions on where the world's going, where interest rates are going. So what does your crystal ball tell you for the next 1 to 2 years?
Well, I do think there'll continue to be incredible buying opportunities. The last 7 we bought have been at least at a 20% discount. And I think we'll see more of that. I will say that everybody's waiting for that wave of distressed assets. I think they will come, but I don't know that everybody's going to be able to take them on. You've got to be able to really, in some cases, do a pretty heavy lift on some of them. So I would say, understand how distressed and what the distress is coming from. That's going to be important. And I think as far as rates, I every day I'm trying to read something on rates to try to understand it. And you can't predict. You can only listen to the gurus. I mean, we didn't predict the 11 rate hikes that happened, right? So I would say stay knowledgeable, though. Read from, all the industry gurus on what they're projecting. Watch the Fed. That's critical. We could see a rate decline anywhere from May of next year to October. I think it's going to be somewhere in that time span. I do think we'll see lots of volumes of deals hitting the market, kind of summertime to third quarter. And I think the time is now to get your capital ready. Start. Even if you don't have a deal today, start having those conversations, have it kind of socked away. Who's ready to go? Investors are nervous too, right? Because they're not reading everything we're reading. They don't see the numbers we see from our properties to know that we're still seeing rent growth. The fundamentals are there, but not at every property. So educate yourself, get your capital ready, partner if you're not quite there, so that you are ready to take on those great opportunities that are coming.
Yep. I've already been sent a few deals from people who bought properties and then they had a variable interest rate. Now they have to sell them. I'm a little bit farther behind in my career than you are, so I don't have a ton of capital ready to deploy. But once we get to the point where we are there, I'm sure there's going to be some good opportunities coming up for sure.
There will be. And that's where those partners come into play. We're seeing them too. Owners asking us to take over the operations of their properties. They just want to save the loan, right? They don't want to go into bankruptcy. And you feel for everybody in this situation. So we always offer advice, even if we aren't ready to take their deal on for whatever reason. And that's what I'll tell people. Reach out, talk to as many people as you can, because solutions come from conversation.
Yep, absolutely. All right, I'm going to take that as an opportunity to move us on to the quick question round. Are you ready?
I'm ready.
Let's do it. It starts with books or any form of education. I need 2 recommendations, one for general life wisdom and then one for real estate specific.
Real estate, I really like the ABCs of Real Estate Investing by Ken McElroy. I think it gets you down to the nuts and bolts. And honestly, it's about the nuts and bolts. So I think that's a good one. The other one that I really enjoyed was The Power of One More by Ed Milet. I think from a mindset standpoint, it's a really good read. It's very entertaining. We were fortunate to be host him on a podcast, and he's just a great guy. And he really is. So that's one that I would highly recommend.
Perfect. Good recommendations. All right. Next question is for your younger self. So let's go back to the Arleen who was still working in banking all those years ago. Go back to her, look her in the eye, give her one piece of advice moving forward.
Corporate America is great for some, but it's not going to necessarily get you where you want to go for everybody. So open your eyes, look for things that you are interested in. And even if it seems impossible, try to figure out a way to get there. You don't have to have tons of money today. You just need to meet the right people. And so I would say take action, but start educating yourself now. Don't spend too much time analyzing, overanalyzing. Take action.
Yeah, it's so easy to be caught in that analysis paralysis, especially with real estate, because a big portion of it is analysis. So, yeah, it's hard. You got to get over that hump, get the deal done. Just especially if you're just getting into it, just don't think too much. I mean, obviously, make sure it's a good deal, but once you think it's a good deal, just go for it, get it closed.
I agree.
All right. Next question is about the U.S. It's a big place, a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
For me, it's DFW. It's a new market for us, but I lived there for 20 years, so I know the pockets within DFW. And so I would say that's a big one. Texas in general. I think we're going to continue to see lots of in-migration and growth. And you want job and population growth, 2 key things for multifamily.
Yep. All right. Next one is about finding the deal. It all starts with getting in contact with the seller and getting a deal drawn up. So what is your favorite way to generate leads and find new deals?
For us, it's brokers. I remember when we first started, I would send emails to brokers. I didn't always get a response. But what I figured out was that I didn't necessarily need to go to the managing director. I could go to one of the associates because they were hungry and they would reply to my email. And guess what? Today, those associates are managing directors. So those relationships, don't discount those relationships. Make the relationships, get on the email list for these brokers. But not just the email list, call them up, let them know who you are, what you're looking for. Even if you're not experienced, they will remember you.
Yep. Well, that's another point towards it's all about relationships. So go out and build them.
It is.
All right. Next question is about lessons learned. Not every deal that we do goes smoothly. In fact, most of them have a few bumps in them. So what is one deal that went a little bit sideways, and what was the lesson that you learned from it?
Great. So the one we bought was an older asset, Class C asset, with a chiller. And a chiller means that you have these pipes and you've got a chiller, a machine that cools the water, and then you have a furnace that heats the water. Well, the way that a unit gets heated or cooled is through this water that runs through pipes into the building. So one, you're the utility company for everything, water, electric, you name it. So the mistake we made was we didn't underwrite a lower capture from utility billing, because when people move out, not only did they maybe leave you without rent, they left you without the utilities, and it can be pretty sizable. We had a mentor walk us through that deal, but they didn't understand it either. And so the expense load was much higher than we anticipated going into it. We got out of the deal just fine. People got their money back, made a little bit on top of that. But it was tough to run because residents didn't understand that it took 2 hours for it to switch from cool to hot. So they were always complaining about it, and there's nothing we could do except explain to them how the system worked. Well, when they moved in, you weren't going to sit down and explain to them a chiller. They just expect that their unit's going to be heated and cooled. And the other thing is these pipes leak over time, right? Older property. Well, when they leak into the ceiling, because the pipes ran into the ceiling, and that's how you got the hot or cold air, they leak. And so your repairs were higher because you had to fix a lot of sheetrock around the part of the ceiling where that unit was coming in. And so look at the mechanical systems, make sure you understand if they're individual or if there's a boiler. Boilers can also be very expensive. So that was our lesson learned, was that mechanical system we did not understand. And we probably will shy away from those going forward.
Yeah, no. And it's the first time I've ever heard about a chiller. So it goes to show that when you're going into especially bigger assets that have things that you don't quite understand, get somebody who knows about them. Like on the mobile home side, which we do, we underwrote a couple deals that had lagoons. I had no idea what a lagoon was, and got to bring somebody in there who understands what the thing is and what the expenses that you'll run into when you take that on as an aspect of your property. So good lesson learned. I'm glad, it sounds like it wasn't a total failure. People still got their money back, but in those lessons we get to expand our underwriting checklist, and we take those to the future deals.
That's correct.
All right. Next question is about your strengths. Everybody is given a gift that we uniquely provide this world. So what is your superwoman strength?
Mine is numbers and patience. I'm a very patient person. I grew up in a family of 10 kids. Wow. So it was almost instilled into you, because when dinner time came, everybody had their time to wait till, dinner was served. And so patience is a big one in this industry. We've had deals that didn't work and came back 6 months later. Yeah. And so I think patience is a big one. And my skill is numbers. My degree's in finance. I was in banking. I like numbers. To me, numbers tell a story. So I would say those are the gifts.
Nice. And I'm sure your Christmas, family holidays are pretty exciting with 10 brothers and sisters.
Oh yeah, it's a blast. We have a lot of fun.
All right, last question, and this is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. What is the best way for them to do that?
You can go to my personal website, Arleen at Arleen Garza. Well, ArleenGarza.com is the website. ArleenGarza.com. Or you can go to invest at reapequity.com, and REAP is spelled REEP. So invest at reapequity.com.
All right. I will put that in the show notes. So if y'all want to reach out, just go ahead and click the little more in the description. It'll pull down that full description, and in there you can find Arleen's links. All right. Well, that wraps it up. Arleen, thank you very much for hopping on the show.
Thank you for having me. It's been fun.
Absolutely. For everybody who's here with us, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all we ask, give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.